right. So today I want to kind of, go through, finish up what we spoke about yesterday in kind of concluding the case. When I say kind of, there's still other things we want to add to this. And just to recap, yesterday we had calculated the returns on 3G. I don't remember what case we're running here because I know it was negative 0.3% in our street case, which is getting revenue growth to match the street. And the task was, how do you, aside from building out the model, how do you think about it like an associate, narrow down all the variables in the income statement, cash statement, balance sheet, and there's a multitude of those, and narrow it down to the ones that matter, better to help draw a conclusion for the case. Thinking about what is 3G's interest in that, and I want to conclude this today. This is also helpful for if you're asked in an interview, how do you do a case study? This is how you should be thinking about it. A lot of people just their minds are too mechanical, right? They think about it from too much of a mechanical perspective. And it's helpful to think about it from a mechanical perspective, but you need to have a story around it. I can't tell you, a lot of times you guys, and I mentioned this in the beginning of the program, you guys will come to me a few months later, whether you're back at school or have final round interviews, vetting a case study, and I look at it and you have this crazy model that you're built, and I said, well, be careful, because probably the quality of the model that you're building is going to be beyond what they're going to see. But then they're going to try to find a weakness, right? They're going to poke holes at what they think your weakness is. And they see you building this big crazy model, fine. They'll say you have the technicals, but then they'll say, well, does this guy really know what he's doing? Or was this like a template that he probably got from his internship and he kind of expanded on it, right? They might think about it that way. You never know. And so I always warn you guys you got to think about the story and the subjective and the narrative. And this is where you guys kind of need to work on that as well. So, I want to make sure you're learning interpretation of the variables as well as the modeling. So that's kind of where we're at here. So we started talking about adjusting the variables. Let me just put this back to the street case here. And then before continuing that, okay, so it's on the street case. So I'm trying to think of what we changed to get it to 0.4%. Was the tax rate? I don't remember. I thought it was negative 0.3%. No, maybe that's what it was.
No, it was negative 0.3.
It was negative 0.3. Do you know what it was? What changed it? Okay. Still, it's telling the story. I'll poke through this. It might have been the deferred taxes. 4% revenue growth. That's what we had. We kept that in there. I wonder if it's, you know what it is? I wonder if it's the debt pay downs. And you sure that was before we linked in the interest expense interest income? Interest expense interest income might have changed it. Okay. So let's continue with linking up this model. Before finishing that, what I want to do is I want to calculate Warren Buffett's returns, talk about his preferred securities, how to model that in, and then let's finish concluding the scenario here. So one thing we didn't do yet is obviously the returns to Warren Buffett. I think this is where it was. The multiple's 14.4. I think we just were at a stage where he hadn't linked the model all the way through. And so one thing I do want to do is finish up linking up, which we haven't done, is the issuances and retirements in the debt paydowns, because when the revolver kicks in, which is going to happen when we set up Warren Buffett's returns, we're going to be out of balance. So we need to link in from the debt schedule the issuances and retirements that reflect the debts that we're going to raise and pay down. So, for example, revolver borrowings is going to be equal from, in the debt schedule, the sum of the mandatory issuances and retirements, which is 0 now. But once we have this kicked in, right, when we show what's going to happen when Warren Buffett puts in his investment, gets his dividends in, this is going to change, and we want to make sure this is reflected. And we'll do the same thing for each term facility. term facility is going to be some of the mandatory and non-mandatory term facilities. Now, one thing we didn't model in yet, the cash flow can't support it, is usually a term loan would have a principal payment. And usually that principal payment is over the life of the deal. So if you model that in, $10 billion divided by 5, there's no way they have cash to support that. So I don't know what's going on there. Another thing to think about in terms of their constraints. Next is their notes. And then these two debts, I believe, are relating to common equity and preferred equity. So the common equity, preferred equity, this is 0. This is if they're going to put in additional money later on, additional investments later on, we would hard code that in. So I'm going to make that 0. I'm going to copy that to the right. So once we've done that, I want to talk about Warren Buffett's investment. Warren Buffett's investment comes in two pieces, right? There's a common equity component, and there's a preferred equity component. What's a preferred security? Who can explain what a preferred security is? What makes it different? Anybody?
Dividends paid are paid before common stock dividends, and they're in the same upside.
Why is that? Yes, so that's one component of it. Why is that? What's the general difference? What makes a preferred investment a preferred investment? How do you describe it or categorize it? So you're right, that is one component of it. It's one differentiating component of it.
The risks are less because even if this year they can't afford to pay the dividend.
Yep, another component. But what is it? If I say what's a preferred security, how do you define what it is? You're right, the risks are less. That is an attribute to it. Yeah. Yeah. That's right. Yeah. And what'd you say? Sorry.
Isn't it cheaper?
Cheaper to who?
The person who gets the preferred.
To the investor, you mean the person that's investing?
The person who's investing.
Cheaper how? Cheaper than what?
In the common.
It's cheaper than common. Why?
In this case, probably because they want Buffett next to it.
Yeah. Again, I'm not getting an overall description. What you guys are right. You're giving me good attributes of preferred securities. In an interview, what's a preferred security? If you say it's more risky, okay, that's true. That's an attribute to it. You're not explaining what it is, though. What is it? What makes a preferred security a preferred security? High level, just the major category. Define it for me. You have in your mind where it fits in the investing scale.
Can be bought or sold in the public market.
It can be. So can some of it. So can any security. Oh, it can't be, you're saying.
Yeah, it can.
Maybe. It's not common. Preferred? Nobody. All right. First of all, it's definitely a hybrid. A preferred is a convertible. It is a combination of debt and equity. That's what it is. It is a convertible. It is a security that has an equity component and some debt component designed to mitigate the risk of common equity. That's what it is, to be cheaper than common equity. And that can come in a multitude of forms, right? It can come in a multitude of forms. So what's Warren Buffett's form? Well, first of all, now, what are attributes that make it an equity or debt component? This can be quite gray. And so a lot of investors, this is where we spoke about in the beginning. Remember the biggest argument, one of the biggest arguments, and we'll watch it in the video for that Warren Buffett and investors had is this actually a leveraged buyout or not? Right? So, that one of the bases of those arguments are, well, there's not a significant amount of debt that they've used to fund the acquisition. They say, well, the debt isn't significant. A leveraged buyout is you got a significant amount of debt. Well, they arguably 44% isn't significant. Some people say, well, 44% is pretty significant. But the other thing they don't consider is he's got preferred. Some people consider preferred as debt. It can be acting as debt. Let's talk that out. It's important to understand. If you treat it as debt, that's 70%. Lots of times in investment banks, we would proportionate this. We do 80%, 20%. We do an 80-20 or a 60-40, depending on the proportion that you think is debt versus equity. So preferred security is some sort of security investment instrument that has some debt component and some equity component. And the debt component is usually the fact that it pays a percent of quote-unquote interest. It's like interest, but they call it a dividend. And it comes with some equity component like stock options or warrants. That's the equity component. Just like a convertible debt. Convertible debt is debt that comes with warrants. Debt that comes with options. So
holders will prefer the equity. They will get dividends year.
Yep.
They will get dividends.
That's one example of it.
Okay.
Yeah.
No matter what the owner will do.
Yeah, it's all, you can negotiate whatever you want, is the problem. So let's talk about.
Aren't dividends like, it's up to management, but if they decide to cut dividends across the board, if they ever were to reinstate dividends, they would have to be paid back for every single year, the preferred shares first, and then they would go to common shares?
If you want that in the contract and negotiate that, you can. It really depends. Attributes that traditionally define a preferred security is, number one, preference in dividends. So that's how there is some sort of usually preference in those dividends being paid. Either they have to back pay if they cut them, or some people say you cannot cut them, or some people say, yeah, if you're going bankrupt, you pay the preferred dividends before the common dividends, but if you can't pay it at all, then you can't pay it at all. But there is some sort of preference in the contract of dividends. That's one attribute that makes a preferred dividend a preferred dividend. Two is preference in assets. So it is higher up in the payback scale. If a company goes bankrupt, then you pay your senior secured term A guys, you pay your second lien guys, then you pay your preferred guys before you pay equity. So preference in dividends, preference in assets. Third is the convertibility into common stock. So a preferred security would either be convertible in some way to common stock, or would have some sort of equity component attached to that in the form of options or warrants. So you'll see a lot, for example, in venture capital. Anyone interested in venture capital? We do a common, if we have extra time, class on capitalization tables, tying in with term sheets. It kind of has a venture capital spin. Maybe we can do that if we have extra time, like an hour on that. We do that with a lot of VC funds. I got the slides for it. We can run through them real quick. But it talks about convertibles and preferreds and how they work in like, let's say, a venture capital investment. A lot of times, venture capital investment would say, if it's a convertible type of security, they say, okay, it's going to be debt for the first 5 years. You put in $500,000. It's debt. The investor would receive a 10% interest payment, and then after year 5, it's convertible at 1.2 times the investment. So they get 1.2 times their money back in equity, in the form of equity, and you convert that and say, okay, well, that's 13% equity. So you have the protection in the first few years of it being debt. If the company goes south, you can maybe get your money back and you're still getting interest. But if the company starts doing well, it's converted into equity and you get the upside benefit of equity. That's a straight up convertible security. Now, a preferred security kind of has the debt component because it's gray area if it's considered equity or debt. But traditionally it's considered equity because it's a one step up from common. Hey, it's debt in the sense that they're receiving a dividend that has preference over common. They receive every year. And it could be, just like I mentioned, converted into equity after a certain amount of time, or instead of being 100% convertible into equity, it can come with a certain amount of warrants or options. A couple ways of looking at it. So the fourth attribute. So first attribute is preference in dividends. Second, preference in assets. Third, it's the convertibility into common. Fourth, the company usually has the option to take it back. Callability. One usual stipulation to prefer. It's callability at the option of the corporation. And fifth, preferred securities usually do not come with any voting rights whatsoever, which make people think that this is more debt than equity. You don't get a board seat. You don't get And with equity, the more you invest, the more voting rights you get. You have a little bit of control. Preferred securities usually do not come with control. So if you think about that, it does sound like debt in a lot of ways. And Warren Buffett specifically is $8 billion. He gets a 9% dividend every year. And at the end, there are some warrants attached to this. It was not disclosed how much warrants were involved in it. I didn't get the feeling that it was significant. So even though it was definitely in the equity section of the balance sheet, it did kind of act a lot like debt. And so this was one of the sticking points for when they argued. Remember I told you in the beginning, and in the press release, a lot of people say, well, is this a leveraged buyout? Leveraged buyouts have the stigma of cost cutting, job cutting. No, Warren Buffett was like, this isn't my intent. My intent is I want to invest in this long term. I'm putting a lot more money in. There's not a significant amount of debt being in there. It's less than 50%. But then the argument is, well, if you consider this debt, which is acting like debt, it's 71%. So that's the argument. The second argument is, aside from the preferred, not only the debt being raised, but how the debt is being raised. And in a leveraged buyout, the debt raised is backed by the assets of the business like a mortgage. And this certainly was. Right? This isn't debt that Berkshire Hathaway was raising from his company and putting into the business. It's debt that's held and liable to the company in and of itself. That's another point I would believe that would lean this towards leveraged buyout. And 3G is investing in it, and they just a year before invested in Burger King and fired everybody. So that wasn't a telltale point. They're known to be a very aggressive leveraged buyout fund, and they're managing the deal. I don't know how that wasn't a red flag to anybody. All these articles came out. Oh, Warren Buffett said it's not a leveraged buyout. It's not a leveraged buyout. Yeah, that was another one. Same strategy. Turn over the CEO, massive cost cutting.
It was just a standard acquisition.
But it could have been, but they did aggressive cost cutting, right? But you're right. Yeah, that might not have been. So maybe they could have used that as an example.
I think they implemented it.
Tim Hortons was after though, right?
Zero budget. Zero budget. They implemented
That's what they call it? They call it a zero budget strategy?
zero budget strategy, yeah. So basically every year you forecast from scratch.
Yes. Oh, I heard that they do that, right. And then they just kind of redo. Okay, well, we'll get to that conclusion soon. So before I do, so what I kind of want to mention is let's get into modeling out Warren Buffett's interest, Warren Buffett's return, how it compares to 3G's return. But before we do that, we need to figure out how to model out his preferred security. So what do you think? How do we model out his preferred security? What do we need to do? What are you guys guessing? No, and that's the thing, because I'm going to tell you right now, 9% of that is $720 million. There is not even close to $720 million in cash. So that was a problem. I would guess for him to invest in the preferred, to find it a benefit, he would want that $720 million a year. That's his interest. Otherwise, he'd just make it equity, right? If he's going to defer it all, why not just make it equity? I don't know. But so what we're going to do is we're going to model out both ways and have a switch. So I want you to know how to model it out. Just a straight up dividend in a preferred, and then how do you model out if they defer that quickly and effectively in a switch, and how that impacts the returns. I think it's important. So that's what I want to go through before the break. Then I want to conclude, go through the variables, and see what the strategy is here, what happened. So what do we need to do? How about the preferred security itself? What do we need to do to model that through? What do you expect to see in the preferred security? Dividends. Okay.
So that's what financing, if you're going to have them hit every year,
Yep.
then you have the, what's the 20?
What's the flow? Income statement, cash statement, balance sheet of the dividends. What's the flow, income statement, cash statement, balance sheet of the preferreds?
We would show it before net income to common.
Okay. Yeah. What? The dividends?
Yeah.
So we have preferred dividends. Let's say it's 100. Out. So you're saying net income? 100?
Yeah.
Okay.
And cash flow from financing,
Yep.
that's gonna drop 100 as well.
From financing.
Yes.
Which net income we started with then?
Well, the minus 100.
You sure?
Will we add it back?
You don't add it back, but remember net income before distributions.
That'd be net income from common, yes, it'd be 0, okay.
That's what you mean by from common.
Yes.
Gotcha. The pre-net income, the pre-dividend net income.
Well, right. Well,
Like, preferred dividends to income statements.
I mean, it's really not doing anything here. Yeah, I know what you're saying. It's not really going anywhere.
Yeah, it's not.
Alright, so we need a net income would be 0 then. If we
Yep.
want to look at net income to common for both income statement and statement from cash flow.
Yep.
So it'd be 0 for cash flow from operations, cash flow from investing, and negative 100 for cash flow from financing.
There you go. Is that what you said?
And then obviously cash and cash equivalents would be
Cash down.
And our preferred stock dividend.
For a dividend is what?
Would this change? This wouldn't change retained earnings though. It would change something else. It would be preferred dividend.
Yeah.
Yeah, it should change retained earnings.
Distribution.
Dividends is.
Right, but would retained earnings also incorporate preferred stock dividends, or would there be some other
Yeah.
line item?
No, retained earnings is always net income after dividends, after distributions.
Okay.
That's the balance. Okay? Straight up like any dividend, like any distribution, let's model it. Finance activities down, cash down, balancing asset is cash down, retained earnings down. It's important to draw it out though to show the difference between doing that and what happens if we defer it. So let's model that out. So I'm going to put in preferred dividends. I'm going to do it up here because I think it's laid out better, although it doesn't matter so much. And this is the way I did it in the book. Where are my dividends? I don't have any. Okay, non-controlling interests. I'm going to add a row under here, okay, called preferred dividends. And then underneath, I'm going to have the percentage, just so it's kind of laid out and clean. I guess I could have done it straight in the financing activities, but good to show distributions on the income statement. Okay. So I'm going to do preferred dividends percentage. I'm going to italicize. Second here. Bold, italicize. And it's 0, of course, in the past. Brian, you're saying this is the RAM? Should upgrade this.
Yeah,
It's the RAM?
sounds not like it.
But my concern is other people said they're having this problem, and this is only with this model.
Yeah, I disagree with the RAM comment. It's the model.
Because yours is slow? What could it be? Okay, so okay, so maybe you and I have crappy laptops.
Probably.
Okay. All right. Yeah. Okay. 9% is what was stipulated in the proxy. They said that his preferred would be 9%. So let's hard code 9% all the way through. I want to see if I can pull the note that says it. It's not so important. 9%. Okay. Blue because it's an assumption. It may change. Okay. And unbold and italicize. And 9% times his investment is the dividends. I'm going to leave it as positive, just the way that expenses are laid out in an income statement. 9% times the investment that'll anchor is $720 million. Okay, and I'll just adjust this net income formula to be after those dividends. So there's losing money. Not that it matters, it's going anywhere. Net income negative. Yep, just that 9% times his preferred investment of $8 billion. That's what we're doing here. 100. This goes to the cash flow statement, but the cash flow statement is net income before dividends. So we don't have to make any changes to this part. It's still pulling the net income before dividends, which is what we want. Right? We do need to make an adjustment, though, to our cash from financing activities, as Daniel suggested. And what I'm going to do is I'm going to use this dividend line item. I could have added a separate line item for preferred, but I'm just going to say dividends including preferred dividends. Preferreds. Okay. And I'm just going to, why add another line? There's all zeros anyway. I'm just going to link this in from those preferred dividends as a negative because it's a payout. Right? I'm not double counting because I'm using the net income above that's before dividend. So I'm going to make this dividends minus negative up here so that if I ever change the assumption, I'll change it here and it flows all the way through. Okay. You can start to see why we had to link up those revolver borrowings. The revolver kicks in. Right? They can't afford it in this year. And that's the red flag. Notice I have conditional formatting to pop up, noting that they don't have the cash to support this. They got to dip into their revolver every year. So I doubt this is going to happen. Okay, I'm going to make this black. Bless you. Okay. You got that? No? Need a minute?
I don't think that one had the, I'm not getting the wrong, so.
Did you link this up here or is this yellow?
Still yellow.
Yeah, you didn't link it up. Because it came in after we linked it up. Gotta link that in from the revolving mandatory issuances and retirements. J261 plus J262.
So J61.
261. J262.
Got it now.
Okay. Now we got to get the balance sheet balancing. What's missing? What has to happen? The cash has to go down, and it does. Look, it's hit the minimum cash cushion. Right, so the revolver is working. It's raising just enough to fund that cushion. And why is it not balancing? What do we need to do? Retained earnings is net income after distributions. We have after the basic dividends right there plus J60 plus the dividends that we've just paid, that we've just modeled, 720. Copy to the right. Now we balance. Good? What does this do to the returns? Let's look at it. Kills it. Why does it kill it? 18.1. Yeah, dividends are being paid. So what does that mean?
That's that pay down more interest.
Yeah, what else? More simply. What's cash? Less cash. How much less cash? I don't know, but it's down by how much? How much more? Yeah, which is what? Right there.
So good, like,
Yep, which is what? 3.6 billion. 3.6 billion. What else? Yes, but what's wrong there? Something's wrong there.
It's red, so.
Yeah.
What is it? It says 2.6?
Yeah.
I know.
Well, it should be in your model.
We're not paying, it'd be double counting. the way
Yeah,
it's set up.
double counting.
So you have to spread it out from 2014 to 2018.
We're double counting, right? Because cash is down by 3.6 billion, and actually the revolver has to kick in to support that because it doesn't have enough cash. But we also have 3.6 billion being paid out. We forced this yesterday, so we got to zero this out. We'll use this in a second. This is double counting, right? This 3.6 billion is double counting. So we're back to a negative 0.4. It still got worse. It got worse by 0.8%. Still got worse. Why did it get worse? Same thing. 3.6 billion. 3.6 billion. Something else happened. Yep. Why?
Well, we're not paying that much debt anymore.
Not only that, but what else? We weren't paying down debt before. We didn't kick that in. Revolver what?
You're now paying interest on
Interest on the revolver. We had to raise the revolver to fund the debt. So there is an additional impact of after-tax interest expense on the revolver. Importantly, you start to think about impacts on debts and interest and after-tax interest and things like that and how it impacts the IRR. So it's paying in cash versus having to raise the debt to fund it and the interest on that. Okay? All right. Now let's figure out what Warren Buffett's returns are. So I want to see, first of all, his equity investment. I'm going to put his equity investment in negative assumptions. 4.12 is his equity investment. Minus. Preferred equity. He puts his preferred equity in. 8 billion. So a total of, I'm going to sum this up. He's putting in 12,120, right? Yeah? What do you get back? How do we calculate the return? What comes back?
his equity component, the percentage of equity.
How much percent?
Common equity.
Yep.
And then
30%.
his dividend, whether it's dividend payable or spread throughout 5 years.
So his equity comes back. What about his preferred? It's funny that that wasn't formatted properly. Should have been. What about his preferred?
He gets the principal back, but he also gets the dividend back.
Oh, I'm sorry.
It depends on whether the dividend is paid
Yep.
all at the end, or we're going to spread it 720 over 5 years.
Well, right now we're spreading it, right? So
So 720, yeah, from 2014 to exit.
So first of all, yeah. First of all, his preferred equity comes back. So I'll just gonna do. He gets his money back. That's the deal. He gets his money back. 8 billion. Right. Notice we have the preferred equity being removed here. It has preference, like debt. Right. Before you spread out who gets what, all the debts have to get paid out. He's got to get his money back. That's the benefit of a preferred security. You get your money back before the common gets spread out to everybody. That's another benefit. That's another reason why it looks like debt, preference and payout. So he gets his equity, but he also gets his 8 billion back. And then there's his dividends. So we didn't model in this table yet. We're going to add this. This is the table, the deferred. I set it up with 2 separate lines. The dividends, though, are going to be each year the negative 720. So I'm going to link this in from, it could be the cash flow statement, it could be whatever. The payout each year, this one. Okay? That's what he gets back. So he's not making a positive return in this scenario. Sorry, the signs are wrong on this. Right? There we go. Okay. So what's his return? IRR, 2.2%. Okay. And the return multiple is, again, the sum of the money out divided by negative, sorry, that's annoying, 1.1. So it's a little better than 3Gs, but it's still terrible. It's still terrible. No way they're investing in this scenario. Right? They invest in the company, not in this scenario. And the scenario we have matches the street. So we got to go back to the variables to figure out what's going on here. We match the street, right? Something's going on. We're too conservative about something big, right? We'll get to that. Any questions on this? You guys have this? You have questions? Want to take 5 minutes to match it up? What do you got? Questions? Yeah?
Does that mean you don't need that line last week?
No, we'll use it. We're going to use it in a second. Take a second. All right. Okay. So let's assume, because obviously, at least in one situation, they're not affording this, right? In this scenario. So let's assume he's going to say, well, maybe I'll defer the dividends, and who knows what he's going to do, but in this particular situation, he's going to have to, right? How do we model out deferring the dividends? So first question is, what's going to change here? If you defer those dividends, what's going to change here? How would you defer the dividend payments? It'll create a liability. It'll create a liability called $100.
Are we assuming that he's not asking for interest on top of that?
No. Let's assume not. Yeah. Yeah. Let's assume not.
Yeah.
So what's the balancing component there? I mean, this stuff will stay.
Cash flow from financing or something.
Cash, right? Will wash, right? Cash is going to net to zero, right? It'll still be incurred. It'll still hit the retained earnings. It's still expensed as incurred, but it's just not hitting cash right now. Add back to cash. So how does that all balance? Right. So there's a preferred dividends kind of payable of 100. That will link to here. That'll add down a cash of 100 and will link to here.
So why are we putting in the backwards statement for $1?
To offset the payout.
Oh, okay. So like, okay.
Yeah.
The
It's
dividend payable would be under cash flow from financing, right? Would that actually be cash flow?
It could go either way. We'll talk about this with paid in kind securities because in one essence it's a loan, and another essence it's not a payable like an accounts payable that's offsetting an income statement line item. I wouldn't consider it operating. So we have to add this line. We have to link it into a dividends payable line, and let's see if it balances. Okay? You guys getting excited? This is the fun part. Okay. Dividends. Let's add a row above dividends. I'm going to call it dividends payable. And I'm going to zero out historically. And then I'll just, I don't know. I mean, how do you want to do it? What do you think? What do we want to see here while it's loading? Yep. Yeah, so we can link it in from the original. We can have it be negative this. So copy to the right, copy down. For now, I'll just make it negative 720, adding it back. I think that's okay. All right. So offsets the cash, not taking in the revolver, looking good over here, right? But it doesn't balance. It doesn't balance because we now have this extra line item that needs to build a payable. So I'll put it, I don't know, I'll put it like under long-term debt, the notes. I'll add a row called preferred dividends payable, right? It'll be 0 in the beginning. I'm not going to either hard code it, or really you'd probably want to add a row in the balance sheet adjustment so it flows. That'll be 0. I'm just going to put it 0 for now. And next year is going to be the year before plus the line item that we had just linked up. 0. Year before plus the 720. Copy to the right. And so it builds. Notice that's the same 3,600 that we had estimated yesterday. 9% times 8,000 times 5. It's not compounding. It should balance. Okay. Now what do we have to do? One more thing. Returns. We got to impact our returns. So the cash isn't impacted there. Look, the returns go up because we don't have these preferred dividends in there. We need to, instead of this times 9% times 5, we need to link this in. And we'll use the switch above just so this all flows. We're going to say equals, like any other debt, negative the switch times that balance, which is the 3,600. There it is. So taking this back to what it was, there's our 4%. So now that's all kind of linking together. And what do we do for Warren Buffett? Yeah. So, and actually I realized we didn't have this guy. We got to adjust this so that it's flexible. This is going to be, let's do that now. So his equity value is K14 times assumptions times a switch, right? And the assumptions is anchored. And this is equal to negative F21 times a switch. F21 is anchored, right? That'll work. And then the preferred dividends payable is just going to be negative this. If this exists, it exists. If it doesn't, it doesn't. Right? This should copy to the right. No, and then, right. And then now, how do we take this out? Yeah.
Oh, is it going to be that kind of day?
Exactly. That's what I should say. Yes. We can delete them for now. but we're going to have to put them back in a second. So let's delete them for now because I want to put the switch in, and let's just see. Okay. So his returns went down by 0.2%. Why? What?
Now all his payments are deferred, so yeah, he's not being compensated for just that.
Yeah. The time value of money impact 0.2%. So it's minimal for him whether he defers or pays. So a big question in my mind was, where is he going to defer or pay? And if my point is to look at the overall returns, it doesn't matter. I just know that the cash flow model can't support it right now, so I would just defer, right? And then we'll kind of figure it out from there. Okay. But what if we don't know, right? And like I mentioned, as a good, efficient analyst, you should be, if there are big questions like this, we didn't do this with accelerating depreciation, but you should have the model set so that if it's the last minute before the deal closing and they say, well, this is actually going to happen, you can just switch it. Let's put a switch that says whether the preferred dividends will pay in the end or will pay incrementally. How do we do that? Let's tweak the revenue back to the 0.4%. Right? So let's say their strategy is just the cost cutting. If it's just the cost cutting, it's ridiculous. So you would think that that's their first angle, and that's the easiest thing to do from a mechanical perspective. So the irony was when this came out, in order to prepare to write the book, I went to their conference call, and Warren Buffett came out very excited. The guy from 3G, I forgot his name, Latin American guy, came out, was real excited, and the question was asked: is there going to be cost cutting? This is a private equity firm. This is a leveraged buyout. Is there going to be? I said, first of all, it's not a leveraged buyout, and then there comes that argument. And they said, they kind of danced around the question. We love the company. We want to work with the company for years and years and years. We know that didn't happen. And so, obviously, when you go through it this way, there's really no question. Hopefully, there's no question in your mind that there's got to be cost cutting. So I threw it all in the book, and I wrote that conclusion very briefly that there's got to be cost cutting, despite what he's saying, right? Although a lot of people believe in him. So we published a book out. We went through this together. Still a little unsure. And then this article came out. Literally, it was great. Literally like a week after. It was great.
Week after your book went to print?
Yeah.
Oh, that's fantastic.
Yeah, and actually I spoke to her about it. Annie Gasparo. It was great. And then this came out. Buffett back Heinz. This is another one. Then this one. Heinz closing 3 plants. Cutting 13. That was later. And the guys in here, we didn't see it coming. Yeah. There was a great quote about a guy in the place that we didn't see it coming, this and that. And it's a matter of understanding the analysis works. And this is a recent one. I think somebody pointed this out. They're still in cost-cutting push. What's the irony of that?
Where I'm from is London, Ontario,
Yeah.
and they had a Heinz factory there, and they shut it down. And so there was a demand with a lot of local companies that were there that bought Heinz products.
Oh.
And decided to not support anymore.
Oh, good.
My own local farmer.
Interesting. And there's that. And so I got excited. So I did it in the class, and I said, let's go back to the Heinz press release, because maybe I'm making that up in my head, right? Maybe he didn't really say no cost cutting. I wanted to go back to the press conference. They took it off the website.
Oh.
Yes. But somebody put it back up on YouTube. So let's go take a look at it. Maybe it's a timing thing. It's back up here. I don't know if they didn't know WXPI.
I like raw press conferences.
Yeah, this guy he gets raw. I hope we can get sound. It's over here. Right?
So I can relive. So
Yeah, there you go. You'll have to stand up and translate for us,
I got
right?
it.
So you're no longer in the world, okay?
We're not gonna jerk your dare.
That's what he opened with?
Yeah.
I'm not gonna do
It's good.
How do we do? I don't know if this works.
Just gonna lose it.
Brian, I might need.
Brian, go.
Do the wiring.
Oh man, we're missing everything.
I'll rewind it. That seems to be.
25 minutes.
Oh, you know what? My volume might be down here.
User.
Oh yeah.
Yeah, it's coming
There we go.
That's awesome. Okay, let me rewind here. We won't watch the whole thing. I just want to get to.
Thanks for your help, Brian.
A little bit more silence.
Hold on, let me get.
Christian.
Okay.
Be acquired by an investment group led by Berkshire Hathaway and 3G Capital. Two names with stellar reputations for doing the right thing for and with the businesses they own. Doing the right thing has been a credo of the H.J. Heinz Company since Henry J. Heinz introduced his first product in 1869. And that simple premise that served us so well for all of these years has led to today's exciting announcement about a new partnership and a new platform for growing our great company. Under terms of the agreement, Heinz shareholders will receive $72.50 in cash per share.
So he introduces it, right? Let's get to the Q&A.
Share price, and a 30% premium reflect.
He's just talking on and on about. Okay, here's the 3G guy. I forgot his name. He's the CEO. Yeah.
This guy looks like a CEO.
Following Alex's remarks.
Is that positive or a negative?
I don't know.
Mr. Carlos, not.
Thank you, and thanks again for inviting me to be here today. And good morning. I was very excited coming into Pittsburgh.
He's excited about Pittsburgh.
Seeing Heinz Stadium and being reminded that this is the city of champions.
Sorry,
Yeah. Okay, then they exchange shirts. I mean, that sounds weird.
Did they really change?
He gives like a shirt. Oh, it's a towel.
Terrible towel.
Oh, it's so good. There you go.
It's but what you should do when someone's there, you chuck them out with terrible towel. They're the same guy.
And I'm sure Dan, when you see this, immediately call me and say, no, it's supposed to be gold, and I'm saying it's red.
Okay, then we can get. Okay, so they do the introductions and then the questions. It's totally awful.
Here's a towel.
Okay, question.
3G has been associated with some aggressive cost cutting.
This face is like one of the
You know, I think that we've been, involved in a variety of deals in the past. Some of them had a lot of cost optimization opportunities and efficiency, and some of them didn't. And I think here, it's very early to say. I think we just getting involved and have several months ahead of us. We get to understand the team and the people. And this certainly is a company that, if you were to compare and contrast with some of the businesses that we got involved with in the past, this is a company that's doing extremely well as it is, and has been doing extremely well for a number of years prior to our involvement.
Totally.
Did he answer the question?
Didn't answer the question.
Gosh, that was a burning can.
Yeah.
When did this deal start and who saw it?
It started actually.
There's another one.
8 weeks.
8 weeks? They closed in 8 weeks?
No,
They already agreed. Then.
no way. He goes, we don't know. We just still didn't meet the management about cost cutting. I mean, if they looked at it the way we did, which obviously they did.
So we have said that publicly in a variety of businesses. Warren Buffett has said it publicly. It's on the merger in the contract. It's about as strong as they can get.
I forgot where they were going with that.
Monday gave us his assurances that he had absolutely no interest in this company leaving.
I think, are they still in Pittsburgh? I don't even know. I don't know, but
Given my relationship with this, is that I was just follow up on that question. You mentioned that this kind of deeper movement is something we have in Pittsburgh. What changes, if any, will
No, the headquarters in Pittsburgh.
so this is important.
Initially, you won't see any change.
I mean, I think Pittsburgh has been Heinz's home since 18.
So he was fired 2 weeks later.
We will continue.
Yeah. Yeah. He knew. I mean, he had a $235 million balloon exit package. That was another big. Yeah, million. Initially, there won't be any change.
That's cute.
Cost cutting.
3G, and then Mr. Buffett was the ability to use the platform to sort of get bigger around the global food industry.
So, another one more. I'm not going to bore you with, but one more good question about cost cutting.
And I probably think even a year from now, we won't see anything that really will change your view of Pittsburgh. We will simply not be listed in the papers every day and in the stock taking, but we will continue to be here.
They're certainly in the papers.
We will be very much involved in the community.
Have we changed the number of jobs Heinz has doing?
I think it's too early to say, and as Alan said earlier, we have not had those discussions yet. But long term, it could go the other way. Long term, we may have more jobs here as the business gets bigger. So, again, I think the thing you all have to keep in mind and makes this different than most situations is this company's being acquired from a position of strength. I mean, our stock.
That was certainly not true, right?
30 consecutive quarters of organic top line growth. I mean, this company's never been stronger. That doesn't mean there won't be changes going forward. But
Had cash issues,
this will be a platform
terrible growth.
doing bigger and better things in this industry. It is interesting, as an aside, that if you look at the market today, a number of our peer companies are trading up on the news about us. And I will leave that implications of that to your own judgment and discretion. But I do think that our goal here is to make this a bigger, even more global company. And I think that's a goal we share with 3G and with Mr. Buffett.
So, that's.
The needs that some employees were doing here earlier today. What is being conveyed to people? What can you tell them right now that are listening? Number one. Number two, what changes are going to ahead here? Benefits, pensions, or looking right to employees?
Well, I met with employees, Mr. Behrman has done it. I met with employees this morning, and what turned out for me to be a very interesting meeting to talk to my employees. I think I spent about half the time in tears, and the other half telling jokes. And it's a very emotional day. Having said that, I also told the employees that certainly over the next 4 or 5 months before this initiative closes, there will be no changes. That they will continue to be expected to perform their job as usual. The business will continue to run the way it's been run. Leadership won't change. And I think beyond that, I said,
which was totally.
The value we create as employees, the more opportunities we identify, I think the safer people will be. And I also said to them that there are certain things I couldn't comment on because I don't know the answer to it. And that's one of them. I don't know long term what the employment situation will be. We have 1,200 people in Pittsburgh between our North American operations and our world headquarters operations. And I think given the fact that we're remaining in Pittsburgh and we have a desire to grow, I think there can be some assurances that a number of people are going to remain committed to this company and employed by this company. But I think beyond that, it's just too early to comment because we just don't know.
So that seems to be their go-to answer.
Yeah,
Yeah.
yeah. Well, they're trained. I mean,
Do you think?
I like that expression.
That's
it.
But they will not. They will not.